And so that's what I'm saying. We're buying our real estate deals. We're buying them not just for the cash flow day one. That's a huge component. But as long as we can pay back our PMLs and PMPs, that's number one. Because Adam and I are independently financially free. I'm financially free through my various income streams. I have other businesses. And I have my own almost 30 rentals myself. So that sustains our lifestyle. So we're buying a lot of our deals. What we're doing is we're focusing on long-term wealth generation. Appreciation, tax benefits are massive. Debt pay down's a huge one. That's where those 0% is insane. We just bought a 7-unit property in Puerto Rico at 0% seller financing. That's insane because every single month they're paying down our debt. That's adding to our net worth. It's not benefiting cash flow, but we're not really in it for the cash flow immediately, as long as we can buy the deals and pay off our lenders and partners what they need for these deals. So this one's 0% seller financing, no payments for 12 years. All right, so here's the breakdown. So we purchased the property at $775,000. Short-term rental closed in the middle of July. The total entry fee was high at $142,000, which is broken up between, and this is how we always raise capital, PML or PMP. We always raise money for acquisition costs, which is going to include cash to seller, arrears, agent commissions, closing costs, all that kind of stuff is lumped into acquisition costs. And then we raise the money as needed for updates and furnishings, since we're primarily doing sober living homes, pad split, even long-term rentals, midterm rentals, and short-term rentals. There's always a budget for that, and I put a minimum $5,000 for rehab just to have that ready to go as reserves when we acquire a deal. Oh, our acquisition costs always include, this is a pro tip, if you're raising money, we pay a whole year's worth of insurance too up front. That's like a really nice thing to like raise the money for and pay. It's a very valuable thing to have and just have that money set aside. And another thing, we always over raise to account for money for reserves, especially depending on when we're buying a deal. And if it's a short-term rental, we want to focus on seasonality. And Kalispell is great because it makes money in summer as a short-term rental, and it makes money in winter as a short-term rental. But their shoulder seasons, and going like September, October, for example, shoulder seasons, we want to have several months of reserves ready to go just in case. Even though we're getting bookings, and we said we implemented rent by the room for this one as well to just like fill in, to bring in additional cash flow. That's something that we always save money for. And it kind of sucks because we're giving up typically more, like we're giving up more ownership or more something because we're raising more money or we're paying higher interest. But it's worth it because the worst thing you can do is buy a real estate property, something doesn't go as planned, and then now what are you going to do when you don't have the money to like sustain that property? So we just raise it up front. We raise the extra $15K in this instance.
How do you calculate your reserves? Is it like?
I'll get into an underwriting later. Let's go high level for now, because I'll pull out the spreadsheet that I used anytime.
Was this place already short-term rental when you bought it?
No, actually, it looks like it would be, right? Because we bought it like 80% furnished, 90% furnished. They only took some of their personal. You'll see some like nails and all that sticking out because they took personal possession with them. The lady, well, shit, I'll tell you. Her name is, her name is, where's that lady's book? Oh. Maybe they moved, my wife and mother-in-law started rearranging stuff in the suit.
Oh, I can't see what I said.
I know her name. Oh, her name is Kelly Pelfrey. She's like an artist, and this house was like their house, and she's like a super artist. And so she made this home like beautiful and artsy, and like when you saw the downstairs, for people who saw the downstairs rooms, like every room is like individualized, has like artwork and all that. It's not like, and they got like wallpaper and all this cool stuff. They just like lived like this, which is kind of amazing. And now it's giving my wife inspiration. I'm saying, all right, babe, like, like we'll try to do something like this, but I don't got the eye for that. Yeah, so that was a big part of when our acquisition costs were much higher than we typically would pay. But when you think about it, the amount of money to furnish this property like this and the amount of time and all this extra stuff easily cost that $60K, or like it would have amounted to like $30,000-$40,000. And the big one too is carrying costs. If it's already primarily furnished, we're not wasting money paying mortgage payments, paying all these extra costs, furnishing the house, all this stuff. Especially because if you really think about it, yes, we pay them the $60K up front, and the remainder is the acquisition cost, but we pay them $60K up front, but we have that 0% seller financing. So some of it's like theoretically financed, you know what I mean, like in that sense. Okay, and we do that a lot. So we love our short-term rentals, buying them from failed operators, people who didn't know how to operate a short-term rental, and we know that if we know that the numbers make sense and the underwriting makes sense, we'll come in and do that. And here's another pro tip. We do that with rent by the room or pad split as well. That's one of my favorite types of deals when we're doing our own direct agent outreach and seller outreach. Well, typically, actually, it's agent outreach for that. When we're doing that, we love to get short-term rentals and convert them into rent by the room if it makes sense, because it's already really well furnished, really well renovated, And so all we have to do is add a few non-load bearing walls and make a few extra bedrooms. That is a really good way to like minimize your entry costs, because all of our pad splits end up costing at least $100,000 for entry costs, because the furnishings, the renovations, all that stuff just starts adding up quickly. So minimizing those entry costs is really valuable. It just sucks in this instance we had to give them $60K, but that was their like, that's why we were able to structure 0% seller financing, no payments for 12 years, buying the rest out sub 2, because they needed the money. And it was like, okay, fine. That's like, right, we always talk about like, what's their motivation? That was their motivation. They needed that to move to North Carolina and take care of family. So it worked out really well in that instance.
What was the sub 2 amount?
So I have all that very specifically in my notes. Okay, so I'll tell you rough numbers. So $775 purchase price, $60K was cash to seller, around $500,000 was the loan itself at 5.625%. Not a phenomenal interest rate, but it's really not terrible. I'm not one of those guys that believes in, and if you post on Facebook and you ask for this, I'm not knocking you. I'm just not someone who's gonna say 10% entry or I'm not looking at it. Interest rate under 3% or I'm not looking at it. Like, that stuff doesn't make sense, especially if you like are really underwriting deals. If you have a higher entry, but the deal makes sense and your cash on cash return is there, like, why is that a filter? If it's a higher interest rate, but you're still getting you're getting your cash on cash return goals and your other investment goals and you're meeting your investment criteria, like, why did that interest rate matter? And I'm saying that kind of like a little facetiously, because obviously the higher the interest rate, you're wasting money on interest. But at the end of the day, well, for me, it's a tax write-off. Interest is a tax write-off. But also, like, if the property makes sense, who cares? Like, who really cares? You're really not going to buy a deal that hits all your numbers because interest rate is 1% higher than you want. Like, people are too, like, rigid with a buy box. And I think it's good to be able to filter stuff quickly. But it also is, like, there's a reason why they're not buying a lot of deals, potentially. That's you. I'm sorry, but I'm very transparent. If you're part of, like, my wealth through real estate free school community, I talk about this stuff all the time. Like, it's really all about, like, does the deal make sense, right? You got to underwrite these deals, not cheat and filter and quickly screen stuff. Like, analyze the damn deal if you want to buy it. But there is ways to quickly screen it. All right, so $775,000 purchase price, $60K cash to seller. I think there was a little bit of agent commission. There was an agent commission, it was a small amount. And then $500,000-ish for the sub 2 loan at 5.625%, and then around $215,000 was the seller finance loan at 0% with no payments for 12 years. Sick. Entry fee in total for us was $142,000, broken up between our acquisition costs, our updates and furnishings, and a big part of that is we're adding electrical and a hot tub out in the backyard, because that is like massive value. When we're identifying our short-term rentals in a certain area, we're looking at what are the amenities the best performing properties have in that area. Hot tub was like a huge one. Summer, winter, doesn't matter. We got more money that will be going towards the backyard furnishings, like the chairs and all that. They're outdated. We don't care because winter's about to come. Let that shit run one more winter. If it breaks a little bit more, whatever, and we're gonna give it a whole clean slate in May of next year, right before the next summer season. And then reserves, as I mentioned. I even with the amount of income streams that I had, and I just had a high-paying W-2 job as of like 2 weeks ago, and before I quit. But even with all that, I still raise the reserves because you don't want to get into an investment, shit hits the fan early, and now you just waste all this time and money, and you got nothing to show for it, or you have to do a capital contribution call on your private money partner. It doesn't piss them off. Raise that money in advance, have those reserves for when something goes wrong. And they already know that. It's like a safety net. They really do enjoy that, or appreciate that. So what we offered on this one, which is higher than normal, our entry fee was $142,000 total. We gave up 40% equity of this property, and we gave up 100% cash flow, but that's a little disingenuous. So we try to get all of our private money partners. So if you ever want to lend with me and be a private money partner, this is exactly how it is. This helps me a lot to raise capital very systematically. We offer 7% for this deal. Where our goal is always to get our private money partners 7% cash on cash return, and around a minimum 15% return on investment when you account for appreciation, debt pay down, appreciation, and then we also allow our private money partners to stay at our properties because it's super sick. It's great for content. Thanks, Pace. That was like he never said that because he doesn't really like short-term rental anymore. But it was an inspiration from him about like, oh, cool. Let's come here. We're at community camp. Let's stay at the house together or whatever. Those kinds of things. So you see right there, target quarterly distribution was 7% cash on cash return. The cash flow 100% is disingenuous in here. What we did instead was a 7% preferred return. If you're familiar with multifamily, a preferred return is essentially you're going to give them 100% of the cash flow until they achieve this return on their money over that period of time, and the rest is distributed based on ownership. Okay, so that's what we do. We provide a preferred return to really get them that number. In this instance, we basically are giving up the majority of the cash flow to our partners, but this property has a lot of value to us outside of that. And as I mentioned to Vishkar, we also manage these properties in our portfolio. Our partners, private money partners, have the option that we use a third-party manager or we use our own management. They always go with us, and if at some point, it hasn't happened yet, but if at some point they don't like it, we can transition to a third-party private manager. But so we're getting paid as managers of properties that we own. I would never just manage properties for the hell of it. That would not be a business model of mine. But managing your own properties and getting paid to manage your own properties, but then adding massive value to our partners by offering a lower percent property management fee than we could get elsewhere. And we care about our properties way more. Property manager's not going to do the stuff that we do. Okay. So that was the total entry. What we did for this one, this was the first time we did something like this. And this is why I asked Pace a lot of questions about something like this. So instead of doing one $142,000 capital raise, we split this into up to four partners. So basically the capital raise could be bought into 4 equal shares. You can buy 1, 2, 3, or 4 of it. So if someone wanted all 4, half, 1, whatever, it's up to them. We ended up getting 4 different private money partners for this deal. We could have had one of them pay more, but it worked out better to like have more owners with us. I really love this idea of it. And we ended up giving them all equal, the exact same returns that we originally providing, but just split it up, right? So if the entry fee is the same amount, or the entry fee is divided by 4, that means the cash flow they were generated is divided by 4, but their cash on cash return is the same. All those other things are the same because it's just a ratio. And and then we're offering them 4 nights a year. And I'm not raising capital from you guys. We already bought this deal. We own it. So just saying, like, this is in the past or like last month. And so we're offering them 4 nights a year. They can stay at the property. 7% preferred return, which essentially means they're going to get 100% of the cash flow. So they get a 7% return on their money. And then we split the cash flow based on our ownership split. So if we overperform, that's great. It means we make more money as the owners of 60% of the property. If we underperform, well, they get 100% of the cash flow until we achieve that 7% return for them. People like that, our partners tend to like that as well because they know that, like, we have to, well, you should always have to perform, but it's like we're saying we're not going to make money unless you guys get your returns first, and then we start making cash flow on this property. So that's what we did. We split it between 4 private money partners, and this is where we went. Let's see, what else do we have in here? So this was the private money partner analysis that I was talking about. If you guys have used my creative finance calculator, this is the paid version. I have a free version. If you go onto like my Instagram or anything, Michael MNAT, you can grab a copy of the free calculator, but I raised all our capital utilizing my calculator because that's why I built it. It's phenomenal for all creative finance transactions. And I've even added more to this since. But this is basically the breakdown over 1, 5, and 10 year timelines. There's a lot of assumptions, right? Property's going to appreciate 3% a year. So we're a little more conservative than national average. Interest payments very straightforward because we've got the amortization schedule. Depreciation is very straightforward. The thing that's not straightforward is the total tax savings because it depends on your tax bracket, if you can even get those tax benefits, if you're a real estate professional or a short-term rental tax loophole, things like that. But the assumption there is that that's incorporated in there. And then most of our buy and hold properties with our private money partners, we have a 5-year holding period. That's like the minimum, so they could really take advantage of the debt pay down, appreciation, all that other stuff in addition to the cash flow. And then anytime within the 5 years, we can all mutually agree. If we mutually agree to end the partnership and sell the property, or we can all agree to sell the property early on within that first 5 years. Or if a partner wants to get bought out, they can get bought out, but they're basically changed to a PML over that time period at like a low fixed interest rate return because they're kind of putting us in a bind. So they get like 3 to 5% interest rate return on that money. It's kind of like they put their money in a CD or something like that. And so yeah, this is the breakdown of what the returns look like for the collective. But remember, all you just do is if it's 4, everyone's just getting their same ratio of this. So they're getting, so this one is close to 8% cash on cash return. 7% of that is a preferred return, and the rest comes from their remainder of the ownership, like their portion of cash flow after the ownership. And then the return on investment when it counts for everything was around 21%. So this is very standard. If you're my private money partner, you're going to get 7% cash on cash return typically, and then you're going to get around 15+% return on investment depending on the deal. And the amount of ownership percentage you get is really a ratio. that's incorporated in it, but it's also a ratio of the entry cost versus the property value and things like that as well. That one's kind of like, you know, we're just messing with numbers to make it make sense at that point. That's where my calculator is really helpful because that's what I do. I just sit there and figure out what numbers make sense for our partners. Because like it doesn't matter what our returns are if our partners don't want to partner with
The
us.
ROI includes the equity. The ROI is total, right? That includes the ownership.
Yeah, so like their portion of debt pay down, appreciation, and then the tax benefits come from their ownership stake. Their percentage for the cash on cash return is just cash flow, which comes from the cash flow percentage. In this instance, ignore the 100%. It's really 7% preferred return, and then they get their 40% cash flow, right after that's achieved.
Yeah, but what's the return on investment? That's the 20%. Is that includes
So
the
here-
ownership 40%, right? That includes
Yeah.
That includes the appreciation, right?
Yeah, so this 7.96% is just,
Yeah, that I understand.
well, just for everyone, real fast. So this 7.9 or 8% cash on cash return is their cash flow divided by their entry cost, right? But for if they're doing it, if we have 4 partners instead of 1, it's still the numbers are smaller, but the proportion, the ratio is still the same, right? And then the return on investment is the cash flow, the debt pay down, appreciation, and then the correlating tax benefits, right? It's not the 20,000. Some people do this shit. It blows my mind. They say, oh, your tax benefits are 20,000 because there's interest payments and appreciation. But that's not true because you can only write off based on your tax bracket, whatever your highest marginal tax bracket is. Can someone take a photo? That really appreciate that. And then, so that's what the total benefits here is. That divided by that is their return on investment.
Oh, so
And that's for that
you're
1 year
not even
time span.
counting the ownership, the equity position, and the return on investment.
Well, because their ownership percentage, yeah. So like for the exit and all
upside,
that,
yeah, the
yeah.
carry-
So
the carry
actually,
interest, you're not
yeah.
even
So we're not
counting
even accounting for that. And the cool thing for our partners is if and when, when we, well, not if, we'll sell all these properties. When we sell, I never want to own 1,000 units. I will sell everything off, lend money out at 12%, and just forget about all this at some point. But oh gosh, I don't know where I was going with that. Oh yeah, the benefit for our private money partners too is what they're funding into the deal is literally money at the exit that they get. So let's say the property is $800,000, we sell it for $1.2 million at some point in the future, and let's say they invested $100,000 to buy it. So when we sell the property at $1.2 million, the first $100,000 pays them back first. So they get all their original contribution back too at that point, right? And then we split the profit. Let's say the $300,000 in that scenario. The profit based on our ownership percentage. So that's another thing we don't quantify. If I were to quantify it, and I have it in my calculator, newer version than this one because I've made a lot of edits since. But oh, where's my wife and my QR code? Perfect. So yeah, that's not quantified here. They're going to get 100% of their money back at the sale. And then because we're not counting for the profits at the sale, we're not even accounting for like the extra money they'll get there. If we did do that, I could provide them an internal rate of return and all this other good stuff. But we're not even going that far because it's single family. Like this is what most people are typically looking at. You guys can keep coming in if you need to. Just keep squeezing in. This is kind of amazing. This blows my mind. And then so we do have the 5 and 10 years. So when I model it out now, I'm not looking at the 1 year return with an exit, right? Because I'm not going to sell in 1 year. You'd probably lose money to sell most creative deals in the first year because you're typically not buying it at a steep discount for the most part. What you're doing, and then especially with the entry cost to get into that deal. But at the 5 and 10 year mark, that's when you start seeing profits from the appreciation, the debt pay down, especially at these really low interest rates. So in my new calculator or newer version of it, that does have the exit there and accounts for internal rate of return and all that fun stuff.
Good stuff, man.
Cool with the analysis piece? Just for everyone who came late, I'm going to go over it very fast. We bought this property for $775,000. It was a hybrid deal. We paid $60,000 cash to the seller. Around $500,000 of it was Subto at 5.625% interest rate, and then the $215,000-ish was seller financed at 0% with no payments for the first 12 years. So it's like sick. And then the total entry was $142,000 between acquisition costs, which are cash to seller, agent. There was no arrears, the closing costs, things like that. Updates and furnishings around $22,000, primarily to add the hot tub to the backyard and all the electrical associated with it. Finish up most of the furnishings. We bought this place 80-90% furnished already. So finish up the furnishings, do some minor repairs, and then $15,500 in reserve set inside. And these were the returns for our partners. But that's what this other slide was. Oh wait, should I? Oh, questions. Do you guys have questions before I proceed? This is the bulk of it, right? And then you guys want to walk around and enjoy the house, except for upstairs because my baby's sleeping and I don't want to bother my baby. Any questions about the way we acquired the deal, why we acquired it this way, the terms of the acquisition? I'm pretty thorough when I talk, but it's
when
fast.
you're buying the deal, what are you looking for in terms of metrics?
Like the returns?
Yeah, so typically multifamily will buy based on our internal metrics for returns, right?
Mhm.
What are the returns to the investors? Do you typically look for a specific return to the investors when you're looking at a property, or
Yeah, so
the 7% cash on cash? I understand.
yeah, we will not buy a property unless it can allow for our partners to achieve. If it's a private money partnership, not a private money lender, right? If it's a private money lender, we need to make more than 12% cash on cash so we can pay a PML 12%, right? And for private money partners, we need a deal that allows for us to pay our private money partners 7% cash on cash and generates over 15% return on investment. That's the metric. And if we need to pay our private money partners 7% cash on cash return, that means the deal has to make more than that for us to be able to pay them, get them 7%, right? That's really all we're looking at. We're also looking at like market specific. Like I said, I wouldn't typically invest in Kalispell if it wasn't for Subto, Pace Morby, Community Camp. This one's a very unique property, and this is why, right? We got to do awesome stuff like this. But we're looking for like population growth, good economic indicators. We know these properties are going to appreciate in value. Like we don't buy properties in markets that are less than 30,000 population. We don't do things with only one real economic driver in a market because we want to make sure that property is successful over the long term. Because if we're giving up a lot of our cash flow to our private money partners and lenders, we want to make sure we're getting a ton of benefits in the appreciation, debt pay down, all that good stuff from the ownership side. And for us, it's very important because our exit is to sell all of our assets in 5+ years and have $25 million of equity between us, between our business, to be able to cash out on, 1031 it. This was a Pace thing. Me and him talked a lot about this. For an owners club, this was a big focus of ours. We were thinking of the exit, at least for when him and I talked. And our exit is $25 million of equity to be split between Adam and I and our team, and then be able to take each Adam and I $10 million and then do what we will with it. For me, putting that, lending it out at 12%, we'll say, that's $100,000 a month of cash flow just from lending in the principal balance stays.
Right.
That's pretty solid, and we have all the tools and skills to be able to do so. So that's kind of what we're looking at is the long term.
Yeah.
But all the cash flow, our property management business, JVing and wholesaling, my own portfolio, like all that stuff sustains
People
the cash
are
flow.
okay with 40% equity?
People are okay with 20% equity
How do you
Really?
decide the equity percentage?
Oh my god.
Because they're getting all that plus.
because they're getting all that plus. So the equity. So remember, we wouldn't the equity percentage is going to depend on. The equity percentage is going to depend on what they can get as return on investment and cash on cash return, right? So like, if the equity percentage is 10% but it doesn't get them the returns, well then we might have to bump it to 15, 20. That dictates it. Plus the entry cost to the don't go up that staircase. Everything else is fair game. The equity percentage is dependent on the entry to purchase price as well as like the returns.
So you gotta hit 15%
ROI at
for
least,
them,
and that
okay.
like so that's why
Annualized, okay.
that's why you can't really do like 5 or 10% because
Sure,
it'd be
yeah.
hard for them to
Yeah,
achieve
yeah.
those returns. Typically the sweet spot is around 30%.
No,
And
I was thinking more like 60-70%. That's what I was asking.
maybe when you're starting out, we used to give up 50%, but now we're at. It just depends on the deal, right? Because it depends. Our portfolio is all over the country. We own 50 different properties, and we own all these different assets, different management strategies, all that good stuff.
Michael,
Yes.
can you talk a little bit about like how you analyze this to make sure the store would generate the income to pay all your investors back what you think it'll pay?
Yes, so as a short-term rental, we analyzed it. So this is what my business partner does primarily. It's a big part of what he does in our business. So we have in-house property management, and this is a big part of it, is understanding your rental comps. So we use like AirDNA and whatever, all those tools to estimate the short-term rental income. And then we just, I don't know, we take that income, we underwrite it, and then, I don't know what I could do a zoom on it. Maybe that'd be easier, or I could pull out my laptop and screen share that. Might be easier. But like just rental income from the different sources,
Okay.
right? Take that, and then we also account for, as I mentioned, Kalispell is very, it tends to be seasonal. Summer and winter are their busiest months. During the shoulder seasons, when you'll see downstairs, and all the rooms will have this, they have all their own electronic keypads. So during the slower seasons, we also rent it out the plan is to rent it out by the room to drive income as well. We don't even quantify that as our rental income during this, but that is a component of it as well. That's like that's the advantage, right? If we're giving 7% preferred return to our partners, we're generating a 12% return. We'll say we get to take advantage of some of that extra cash flow because we drove even more income than we anticipated because we have a decent portion of the ownership percentage. But yeah, specifics on like if you want me to pull up like AirDNA and all that stuff, I could do that. Just be on a
You
computer.
don't have to do it now. I just was wondering if you use stuff like
Yeah. Like I always start with rental income. Like I always start with every tool. So if it's a long-term rental, I'm using Rentometer, Bigger Pockets Estimator. I'm looking at Zillow, right? Getting rental comps for that market, for that property. You guys feel free to keep on coming. You guys can sit on this thing. You can sit wherever. I don't know. You can sit on this thing. This thing was here before I was here, so I don't know. You guys keep on coming. It's all right. So we're always using that data, but then we're also, this is the best reason, like I never bought a single property out of my own local market until I joined Subto. And that was because I didn't feel confident operating in markets that I've never been to. But now I have people all over the country that invest and know these markets. So when Landon Moore and I were talking, and he owns a property right up the street, and he says, here's my property, we're generating this much income. I'm thinking, holy crap, our property's bigger. No offense to him, he helped us with this deal, right? Our property's bigger, it's better, we're gonna add the hot tub, like we're gonna drive it even further, but that's another good data point, like a real data point from local investors, which is a huge value add. And we help him, he helps us. That's like the cool part, because that's what this community is all about, right? We all just make money together and do fun stuff.
Couple questions. I came in late. You're
All right.
giving the partner 100% cash flow and 40% equity.
Let me clarify that. This is, I should change this to the actual numbers. So this is the way it was presented originally, but it kind of is accurate. So we give 40% equity to our partner on this deal, and then 100% of the cash flow up to 7% return, and then it splits based on ownership.
Okay.
The terminology for most people in the multifamily space is a preferred return.
Yeah,
So we're giving them a 7% preferred return or 100% of the cash flow until they get a 7% return, and then we split the remainder of the excess cash flow based on ownership percentage.
But and then
Now the question was going to be, so you're doing it up to 7% return. Are you still underwriting these deals as long-term rentals, or you don't care if they? So because
You know why?
Pace always talks about.
I don't care.
No.
I'll explain it.
No.
No, I will.
I completely understand because sometimes it depends on your exit strategy,
Right.
what you really think. And so if you guys are actually looking at economic indicators and you're coming into markets that you know you're going to appreciate at least 10, 20% over the course of X number of years, it makes sense to sit your money there. You're parking it like an ATM. That's mostly the strategy that you have because you're going to try to do 5 years and then sell off.
Yes and no. The properties have to cash flow. Otherwise, we can't raise money on them and then pay our partners. And It's
Right.
like, what are we even doing all this for? So they have to cash flow. Typically, we have a primary strategy and then a backup strategy. The backup strategy may not make the same returns, but the primary strategy needs to. So that's what we look at. Like, it doesn't have to. After a certain point, I realized the best, and this is what I talk about in my free Wealth to Real Estate community, right? It's on school, whatever, on my Instagram, go for it. But we focus on deal analysis all the time. And what I realized after analyzing thousands and thousands of deals all over the country, the best long-term rentals are going to be that $80,000 house in Birmingham, Alabama, 1 bedroom, 1 bath that generates me $100 of cash flow, but 15% cash on cash return. I don't want a portfolio of those assets.
Sure.
What I really want is to maximize cash flow and long-term wealth generation. That doesn't happen in Birmingham, Alabama, as it does in San Diego, Kalispell, Charlotte, wherever else we're buying, all over the place, like North Carolina, South Carolina, Tennessee, Florida, Arizona, now Montana, California, but only San Diego. I own in Alaska. We own in Washington. We're open to plenty of other states. I said Tennessee. So that's what I had to learn over time. It's like, if I have a very rigid buy box, it worked really good for me to have that mentality of I need 12% cash return as long-term rental. I bought almost 30 rentals doing that, but in Fairbanks, Alaska. That allowed me to achieve financial freedom in literally 3 years. Like, I was able to make all my ends meet and then some in 3 years by building a portfolio like that.
Right.
But I realized what I really want, wealth, isn't going to be driven by that. Because there's always a give and take between, there almost always there is a give and take between
Appreciation and cash flow.
appreciation and cash flow. And on top of that, even more, not just appreciation, but one property in San Diego that we own, $2 million house, pretty much cash flow neutral. It doesn't make us very much money, all things said and done, between the highs and the lows of the year, but we make almost $4,000 a month on debt pay down alone. So let's say I even lose $1,000 a month. I lost $12,000 a year in cash flow. I've appreciated a mansion in San Diego. Let's just say 5%, national average, and San Diego's much higher. Let's say 5% of $2 million. That's a lot of money. Whoever wants to get at math. and then the debt pay down $4,000. That's $48,000 a year. I'm willing to give up at this point in my portfolio. I'm not saying you should, depending on your portfolio. It depends on where you're at in your portfolio design. I am at this point very comfortable exchanging some cash flow for the other benefits of real estate investing.
Because depreciation too. Is
Depreciation. I haven't paid taxes in years. First, my wife was a real estate professional, and as of August 20th, I no longer have a W-2, so we're good. Thank you. It was such a mindset shift. Like, it took forever to get to that point. Like, financial freedom level 2, and then it just got so annoying with my government job that I was like, all right, I don't even know why I'm doing this anymore. Like, it was good pay, it was remote, but it's like, I don't even know why I'm doing this anymore. So I just ended pretty much instantly and said, hey, this is good, but I'm moving on to the next thing, which is the thing I've been doing for the whole time.
Are you building up a war chest just in case?
Yes. So we're always
that has
building.
to go with this strategy, having a war chest.
So that's even up front for a property that we're buying. That's a big part of this, right? Not only are we raising the money to buy the deal, which is the problem for most people, is they're raising this amount of money to buy a deal. What about the updates to furnishings I need to do, plus some overage? What about the reserves? Not just the carrying costs. What about the reserves for several months of mortgages, even when the property is operational? We're already raising that for the deals, and we have partners on the deal. So let's say we need to bring in $10,000 for an unexpected expense. We have to bring 60% of those owners. Our partners will bring 40%. If they can't, we'll figure it out with them, and it's fine because we have various other income streams. We do have lots of reserves. The scariest time in real estate investing, in my opinion, is when you only have like 1 or 2 or 3 properties. Because like something goes wrong, you don't have a bunch of like money floating around. With like 50 plus, we got a lot more money floating around. And because we also self-manage all of our properties and get paid as a private managers, we have a very amazing advantage that we get to. Here, let me go back to our business model just real fast. So we buy and hold real estate and we manage our own properties. And the thing when Adam Catlidge and I decided to buy, let's go to the very beginning so we get you something good to look at. Adam Catlidge and I decided to buy real estate. We agreed, hey, he has got independent income streams. I've got independent income streams. We're buying real estate primarily for the goal of wealth generation. Does not mean we're not buying cash flow properties. Every property has to cash flow, or at least be cash flow neutral. Yes. But we're willing to exchange cash flow for the long-term benefits of real estate investing. And that was something we went into. So what we've done is every single extra dollar, Adam and I still do not pay ourselves yet for our portfolio. We just keep reinvesting all that money back into the business. And on a separate note, when we built out our property management company, just for our own portfolio, and we only work with, like if we are managing others, it's only one operator with a lot of properties, similar to ours. We're trying to solve the, not discount, because it's not discount, but like lower cost nationwide management for like certain management strategies, pretty much short-term rentals and rent by the room. And that additional income stream, we also don't take any money from that either. If you have a property management company that you're paying and there's an owner of that property management company, they need, let's say they make $50,000 or whatever, let's say they make $10,000 or whatever, that's the money they live off of, right? They're the owners, they live off those profits. We take those profits and we reinvest it back into our business. So like for us, it's really nice. That's how we were able to get a CFO, pay back PMLs from other income streams, even if the property may not pay down the principal, we can pay that off through that. And we can take that money and we can hire more staffing to then, like we have various virtual assistants who are not just waiting for passive. This is a huge advantage of our management strategy. We're not waiting for people to just book on Airbnb, right? We have them on like 12 platforms. We're reaching out to, like for our multi-million-dollar property in San Diego, we're reaching out to wedding planners, event coordinators, businesses. Like we just hire, if we have more money, we hire another person to go do that kind of outreach on our behalf. So we're no longer just waiting for business, we are driving business. So we're like, that's a huge advantage of the way we've built our business. But that was, if you know a little bit about me, like my whole thing is intentional investing or being the intentional investor. And that was a big part of, we're gonna take the money and make this bigger and better because we're gonna just crush it for the next 5+ years until we decide to sell properties off, 1031 to a large multifamily, cash out refi, use that equity to then just lend with. That's like the business model.
It sounds like we have a similar business model because the end game always is lending. Like for me, it seems like it makes a lot of sense. Do you guys ever do anything with, to help, like with tax lien certificates or anything like that? You don't do anything?
We stay in our box. We're really good at certain things and we stay with that. We're really good at buying creative deals and structuring them really well, especially from wholesalers. We do wholesale. We disbanded our large wholesale team at the end of last year because it wasn't the main priority. We're Pareto principle. We're buying 80% of our deals from other people. We're just helping them make their deals. They find motivation. We come in JV and help close those deals and make them way better and then buy them. Right? Like that's what we realized that made more sense for our business model than us having a wholesale team. Because the wholesaling side, we're getting acquisition fees, we're getting 10,000 here, 10,000 there. It's like, was the time for $10,000 worth it, or could we have bought one or two more properties? Could we have raised, like I built a great relationship and just raised $200,000 for 3 different deals 2 days ago sitting here? Like that is where my time is better spent than like wholesaling. And that's like knowing where you're at and where you want to get to. That's like a huge part of this whole thing, in my opinion. Like, and that's just kind of how we've done everything over the last 18-ish months since March of last year. Yeah, we bought $12 million plus of real estate, more than that now, since March of last year, because we're very methodical about what we're doing, and then we're taking the profits and just making our business bigger and better over and over again.
You already had cash flow from your personal
Yes, sir.
portfolio, so you could focus on not really getting cash flow because you had your
And I wouldn't.
That probably helps out a lot, because if you're trying to balance both of them, it's kind of hard.
Right, and I tell people all the time, especially in Sub 2, they're like, what, you joined, because I joined September of 2022. People are like, oh my God, you own over 50 rentals and this and that. I'm like, yeah, but I came into Sub 2 with over 20 rentals myself. So like I already was doing the thing, and I was already buying traditionally. I already raised a little bit of money. I already did a seller finance transaction. I did a Morby method on 20 rental cabins that allowed me to achieve financial freedom and get paid at closing. Like I already did a lot of that before Sub 2. Sub 2 was more tools in my tool belt and community to start working outside of my local market. So that was like, I always try to caveat that. Like my journey over the last, 2 years, probably, 2 years, it's about to be 2 years. It's very different than yours probably. Doesn't mean you can't achieve the same thing in 2 years. It just means I had a different starting place than you did. So for me, cash flow was not the main priority. And that's why my business partner and I are very much in alignment with that. If one person needs the money to live off of and the other one's like, hey, I'm here for long-term wealth generation, that may not be the right business partnership for you,
Right.
you know? Like, it's got to all make sense. Otherwise, you're just, it's not going to work. Any more questions?
I'm going to come up with some more.
Okay.
No, the reason why I'm asking is because I see some similarities between like some of the models that we've been trying to do and just trying to get an idea of what other people are doing. Particularly what we have been trying to do is balance cash flow with appreciation. And the only place that I know you can truly do that really well is in the Midwest. And so, but the appreciation is very specific to like certain areas, right? Certain areas. So when we go about doing this, I underwrite a lot of our deals to give us some cash flow, but also to give us that appreciation. And we've had some of the neighborhoods would appreciate 20% in 3 years or 25% in 4 years. But we haven't been going into a lot of the markets where the appreciation is going a little bit crazy, because there's two things. One, sometimes people overpay and they get stuck, and if you're not, financially stable, then it can throw some wrenches, especially if something goes wrong with the property. And just trying to get more discounted properties that has that appreciation built into it with cash flow.
The caveat I'd add is I think most people focus on cash flow by choosing a specific market, when I think a certain management strategy is almost better than focusing on the market itself. Because let's say I'm going to go buy, like I said, a high cash flowing property in, I don't know, somewhere in the Midwest, I don't know, wherever. Where are you buying?
So right now we're in Chicago.
Perfect,
so,
Chicago.
Yeah.
Let's say Chicago, or I can go buy a property in Charlotte, North Carolina and rent it out as a sober living home and make $1,000 of cash flow a month on that property. And I got them for the next 5 years locked into that long-term lease. Or I rent by the room in, where we got 2 under contract right now in Tennessee. Like, I would rather do that and drive it based on the management strategy, but it is higher risk, right? It's all risk to reward.
Like we have one that we just bird, and
yeah, that's great.
So we just birded it. We pulled out $200,000 on the bird. We bought it for $115, and we put $75 into it. A long-term rent, it's a duplex. We can cash flow $1,000. So the appreciation went, through the roof within the short time period just because of how we bought it. But we can see that it's still going up, and so I've been trying to find a good balance between cash flow and appreciation and focus specifically in those areas. But the more that I'm thinking about hearing something, because we just opened the Airbnb. We opened the Airbnb, it was going to be a long-term rental, and we just kind of like fell into it, and it's been doing great.
Right.
And so I'm like, if we focus on trying to find more opportunities to increase
Right.
the cash flow, we probably could get better lenders or lenders that are willing to partner with us longer so that we can do more deals. And I think that what you're saying makes a lot of sense because you can actually partner on them because it doesn't make sense to partner on a deal with somebody and you're splitting $200 a month.
Right, it does
cash
not,
flow.
it's not possible.
But if you take that same house, you turn it into a rooming
Short-term
house
rental, rent
or
by the
short-term
room.
rental, and now you're doing 10. We have one that we're putting 8 rooms in. We can charge anywhere between $1,000 and $1,200 a month for each room. Now it makes sense because we could probably find more partners to bring in on that, and we can raise more money.
Right.
So I think that does make sense.
And the way I think about it is similar to, so a lot of, this is like, sorry, you're gonna hear a bad word. I also invest in stocks, I know. But I don't invest in individual stocks. I invest in index funds because they are diversified. It's the total US economy, essentially. That's what I'm investing in. America increasing in value, essentially. The American businesses, top 500, increasing in value. I think the same for real estate. That's why we do short-term rentals, mid-term rentals, long-term rentals, rent by the room, sober living homes, because that diversification is also a security in a sense. So instead of just all short-term rentals or all one market or all that, that's part of our diversification. That allows us, maybe one company in the 500 goes bankrupt, maybe one property fails to perform. Well, okay, we at least have a lot of other things not in that market, not tied to that strategy in that market that we can also lean off of. And that's one of those things too, where if you only have like 1, 2, or 3 properties, it might be tougher originally or early on, but as you expand your portfolio, that's like a huge safety net as well. At least in my opinion of the way I look at it. So, and like when I say I own multi-million-dollar properties in San Diego, we own 3 multi-million-dollar properties in San Diego. The majority are elsewhere. They're cash flowing markets, right? But every once in a while, we will buy a really expensive property in San Diego that still makes sense. Typically, like I could go over that one too. I got a slide deck I did for, I think, Rob's community or someone's community going over the deal. And like we bought that $2 million home primarily because it was like $60K to take over a $2 million home because he was in such a bind. Like that was the reason why we bought that one. It was such a low entry compared to the value of the property. It made a lot of sense to get into a multi-million-dollar home with little to no money down. But I had to structure all that and set it all up and make it a great deal. But yeah, so like when I say we really buy appreciation, it's like when I'm talking appreciation market, I'm talking like big North Carolina markets or something like that. Not San Diego. Don't invest in San Diego. Don't even invest in California. If I were you, I do it because I love it and I love the long-term wealth generation benefits. But I'm also in California. I'm very local California. I was in San Diego forever, pre and post military, and only recently moved up to Northern California. So I don't think most people should do that. I don't think you should do it until you have 30 plus rentals and you can withstand, like the mortgage on one of the houses is $12,000 a month. Can you withstand that, right? Like, can you withstand losing $12,000 a month? Probably not, right? Like, most people cannot do that. So ignore things like that. That's like a whole different level for the majority of people, at least until you achieve financial freedom and then some. Who cares if I have $6,000 a month of passive income, but then I buy a property that's $12,000 PITI? What am I going to do if that thing doesn't perform, right? So it's like account for your entire portfolio, design it out accordingly to what
What was
makes
your
sense for you.
backup on this one? What was your
Rent by the room. It's not phenomenal, but it'll basically break even with rented by the room as long term.
And so when you're getting private money partners for your long-term rentals, what are your terms for that?
For what?
Do you get private money partners for your long-term also or no?
Long-term rentals are hard to raise capital on because long-term rentals literally generate no income.
Yeah.
Long-term rentals, if I put 25% down, took out a new loan, I probably still won't make any money. I'll make 3% cash on cash return. I can't, what am I gonna do with, you know what I mean? And I'm saying creative finance and all that, but how many long-term rentals have you seen that are generating $1,000 a month? That's why I realized I'm over here trying to make everything make sense as a long-term rental, but it doesn't, and I actually don't care. As long as it works for a few different strategies, I don't care. Yes, we burr a few properties and that helps a lot, but
No, I wasn't gonna say that. I was gonna say, I know, and I agree with you, I know where you can get those $1,000 a month cash flows on long-term rentals. The problem is, the property value is gonna be
Right.
like this. It's no appreciation.
and remember the thing I said, I'm trying to get $25 million of equity in my portfolio in 5-ish years.
Yeah.
That's not gonna come from cash flow. Cash flow is there to sustain our business,
Yeah.
pay off our lenders. We also get that from property management, right? But really the wealth generation to get that is debt pay down and appreciation. Those are the only 2 factors when I model out that actually, oh, Dom, what's up, Dom? Those are the only two. Hi, Angie. You gonna sing for us? I got the mic ready. Those are the only two things that I really account for that exit. The cash flow is there to sustain the business, and this is like the advantage of having that money, reinvesting the profits, paying a CFO $7,500 up front, $2,500 a month to help us with the forecasting, modeling these things out. But then that's what I try to like share with people. Like I pay all this money for mentorships and education and all the services that we use, and I try to help other people out too, using that information. Maybe not everyone has that $2,500 a
What
month.
does your CFO
That makes sense
do?
for us. Our CFO, first and foremost, helped us clean up all of our bookkeeping. He didn't do the bookkeeping, but we realized our bookkeeper sucked and we needed a totally different one, which is fine. I mean, that tends to happen, especially bookkeepers, CPAs, I don't know, they just suck. So we ended up replacing that one, helped ensure all the money made sense, organized the way that the money comes in and out of our business, all of the accounts that we had set up at the amount of properties that we have. It's very hard to keep track of all the bank accounts and businesses and all that. So he helps clean up all that. And then a big thing he does is help us model and forecast out. When this PML is paid back, what's cash flow look like then? Where will the principal come from to pay them out? When do we need to start driving more active income at a certain time? Because we have too many loans that are due. Although for us, we've always refinanced the PML with another PML. So it's not like a big issue. We just take one at 12% and either replace them with another at 12% or 10% or 8% once it's stabilized. Yeah, exactly. Like it's just, I didn't realize that at first until Pace mentioned it when I asked them, either Adam or asked them a question at a family night, and I was like, oh shit. Yeah, that makes sense. Now we have a stabilized asset. We just prove performance at a higher interest rate. Of course, someone else will come into a more stabilized asset. Lower risk, lower reward for them, but at least they know they're gonna get their 10% because it's performed 12%, 12% for the previous person. And then forecasting out kind of all that thing about the exits. Are we on track? How many deals do we need to buy? But I also do a lot of that. I just do it amateur, and he does it really well.
Did you hire him on equity or salary?
Salary. So he's salaried. This was a referral from Pace directly. And he's done this with businesses before. Like the guy that we're working with, specifically veteran, which is super cool, fits in with our brand, Coast to Coast Vets. And then also, he's done this before, helping real estate portfolios financially think about their exits, right? Like he's not there to help us drive cash flow. Well, he is, but he's really there to help us ensure that we're on track to get that $25+ million of equity within that 5+ year time.
Is he
span.
fractional or full-time for you?
Fractional. We don't need full-time. We're not. And this is a big thing. This is a big lesson from Pace was you will never be able, like a CFO is going to cost you like $250,000 a year. He said, Michael, you'll never be able to pay a CFO $250,000 a year without some type of fractional CFO to get to that point. Like, because we just don't have the skills, we don't have the tools in our toolbox or the experience to do that. That's a lot of freaking money. So we needed something in the interim to get us to that point. We'll probably be with him for the rest, because with our business model, we don't need, we probably will never need a full-time CFO. We'll just need a fractional CFO to help us get through that, make sure everything's on track. We might even just use them after a while, after let's say the first year or two, just to touch base every quarter or something like that. So, yeah.
Cool stuff, man.
Yeah. So like this is a business for us, right? We decided at one point this is no longer a hobby, it's a business. That was December of this last year. We slowed down on buying, focused all in operations, brought in an operator. So what we're talking about in Owners Club, we did that early. We did that November of last year. Realized the person that we thought was going to be our operator, she was better as more of an asset manager, overseeing our and we also fix and flip. So overseeing our fix and flips, furnishing properties, getting them onboarded and rented out. That was better. That was her better role. And we brought in a different operator, a very elite transaction coordinator, and who's also an operator of their own business. And she came in as our COO, who's been really helpful. Because Adam and I are dual visionaries. I know I'm like a numbers guy too, but like we're both dual visionaries. And we needed that person in the background to ensure we're not just saying shit all the time, right? Well, actually, Milanaz does know, but like, we just got all these ideas, right? Someone's got to help make sure things are moving along the way they should be. Like, because if it's up to us, we just got this idea and that idea and that idea, and we're going to put in all the work to make it happen. But you also need that person at the back end, right, to make sure it's moving along as it needs to be.
Do you have her on equity or?
Her, yes. So everyone else is salaried. She's the only one on equity. And that's because she proved herself. She actually worked for us. What pays time on ownership? She literally worked for us for a very small project basis. Well, it wasn't very small, but somewhat small project basis to help us build out Monday and help standardize our operations and all that. And then because of how much she did for us, we're like, dude, we need this to, like, we found our Molly in a sense. So we need this, and we're willing to give up ownership to our partner because she's going to help us get to the end goal.
Did I hear you say you use Monday?
Yeah,
Yes. And it's funny because that's what we use. It's been extremely difficult to get other people to use it.
well, I barely know how to use it. I just know I'm notified to look at stuff and to look at it. She does all that. She's like, oh, this thing's get underwritten. You raise how much capital? I'm like, okay, cool, I'll do that. I'm good at just being tasked stuff
Yeah.
on there. I don't know what they do to make it happen though. Like, I'm not a Monday or
It's
CRM
good to know
guy.
that somebody's actually able to use it because we get people to sign up and then they just don't use it.
But it
I don't
depends
even
on
use
what
it
you're
sometimes.
using it for. So we use it primarily for when we have wholesalers bring us deals. It goes into our into Monday,
Right.
not our CRM, into Monday. Then we determine, okay, quick analysis. Once that's done, we determine, are we going to buy it as is? Are we gonna have to renegotiate it? Maybe we know someone else this could be a good deal for, not us, or do we just move on from it?
Right.
That's what Monday's used for. And then if we decide we're gonna buy it, renegotiate, we keep track of it until we get under contract. And once we're at closing, or even our capital raising, then when we send emails to our partners, we're not doing it on Monday. We're doing that on our CRM. That works a lot better to send out. So like capital raisings on our CRM, Mondays for like our deal flow in,
Got you.
and then we're building out property management on there in a sense, just tracking our own properties on there. That's
On Monday?
on Monday.
Okay, sure. Makes sense.
And like I don't know, like they do it. I don't know. I keep
What does
you know.
your main team look like? Not the hired, the equity position players. What does that look like?
Let me just give it all to you. All right. I was gonna do a whole Zoom on this for the owners club community, but so there's Adam and I who are dual visionaries. Adam primarily focus on the deals coming in and the initial analysis. I am raising capital all the time. And then once we determine we want to buy a deal, we'll do a deep analysis together and we'll determine, okay, we want to buy this deal or we need to renegotiate it. What are the terms that we need to raise capital, right? So what are the acquisition costs? What do we anticipate for the furnishings and reserves? And we decide to buy that together. So those are the kind of the rules we face. And then I focus on overall business operations, driving our business forward. What do we need to prioritize? Like, what's our quarterly goal? Like right now, it's improving our standardization of our property management. In the future, well, whatever, I'm not gonna get into the weeds. And then Adam focuses on the property management side of our business. And then we have our COO who does operations for like through everything. And then underneath property management, we have an asset manager who oversees our fix and flips, property management, properties getting, set up and all that stuff. And then underneath her, under the property management, asset management, or under asset management is property management, we have several VAs. And Adam oversees all that stuff, and with my support, but he oversees all that stuff. And then we also have like a full-time TC and like operations manager, basically for the due diligence phase, and then like post-closing stuff. That's like our business. So Adam and I as dual visionaries, I focus on capital and final deal analysis and business operations. Adam focuses on property management, initial deal analysis, and then we come together again, right? We don't buy a single deal without each other. Even though we have the authority to in our LLC, we don't buy a single deal without full agreement from both of us. And then we have our COO, we have our fractional CFO, who there's technically then a bookkeeper underneath him as well for the financial management. It's part of the ops, we'll say. And then full-time TC and operations manager, really for the due diligence and post-closing. And then our asset manager with property management and VAs underneath them.
So asset
That's our
managers-
entire org chart.
So asset managers also paid salary?
Paid salary. We tried to pay a percentage of property management. We try to do a variety of things. We realized the best thing to do, we try to do for every deal that we buy, you get X dollars. It didn't really work out because her business was setting up and managing our assets, not helping with buying deals. So she could work really hard to make a lot of money on the back end for our business, but if we're not buying more deals, she's not getting paid for that. We said, we're gonna give you a salary. You're an employee. You're a perfect employee. Let's go that route together.
Right.
Yeah. I don't think there's much else here because
And who does the CFO report to, you or Adam?
everyone, I don't know, me, Adam, and the COO. And the COO works to like set up, Alyssa works to set up our bank accounts, or like works with the CFO to like clean up the bank accounts and the financials, but also our asset manager kind of does that too. And remember, we're just like figuring this shit out, right? Like we don't know, like we're figuring out, we're doing it really well, and we just have to just continue improving one step at a time. This wasn't the way it was. For my first 27 rentals, I found the deals with the realtor, but I found the deals. I can't believe it. He was a good dude. He helped me understand how to evaluate and look at properties. Wasn't really good at like the numbers and all that. That was me in choosing what properties we do. But it was me to find the deals, basically negotiate the deals. Once we closed on it, I was doing all the repairs, and then I was managing my own assets. I did that for 27 rentals, all on my own. And then realized, holy shit, I am financially free, but I hate everything I'm doing right now. Why am I like breaking my back? I literally stayed up all night doing flooring and all that stuff, learning all these skills, drywall dust all up in my throat. Like I didn't know what I was doing with drywall, and all of these things, managing properties, and it took setting up my first short-term rental, and a guest texting me at 11 p.m. at night wanting cooking oil that they didn't have. They're like, it was like the second day or something like that. We didn't even offer cooking oil. So like that was like what they mentioned, and I was like, I'm done. I don't like to manage properties. I don't cool with long-term rentals. I don't like to do customer service or like that kind of stuff. Like guests and all that. Hospitality. I'm not a hospitality guy.
Did you get the cooking oil though?
I did, because I'm that kind of guy who will go do that shit even if I don't want to, because that's just the way I operate. So I did do it even though I did not want to. I drove to Fred Meyer's, that's what the store that was there, and then I went and gave him the cooking oil. But that was, so early on I realized the first thing I'm going to outsource is property management, and then I got a bookkeeper, and then I started hiring out contractors, and then that's when I joined Subto and realized, okay, wait, I can take this thing to the next level. But that's really what I tell Pace all the time. Pace, real estate is like I didn't like really learn a ton about real estate necessarily. Not that I didn't learn a lot. I did learn a lot, but I didn't really learn about like real estate and buying deals like from Subto. That's not really the main value that I got. Being a leader, a business owner, someone who delegates, not someone who's like an operator forever, someone who like owns his assets and manages his business right, and then scales and grows through capital raising and all that stuff. That's really the main value that I got, was like turning this thing that's why I say I turned it from a hobby that I was successfully operating, or a small business that I was responsible for, right? It's the issue with most small businesses, they die when the operator stops performing. And that was the case. I was never going to be financially free the way that I was doing it, because it still required so much of my time. So like maybe I'm making the money and it feels like I'm financially free, but I'm just replacing my time for that money, and that wasn't what I wanted. So then it took Subto and all that to then change that mindset for me to like start doing this. And now we have the CFOs, the bookkeepers, the 2 dual visionaries, the asset manager, CO, all that stuff. But like that's where it started from, like doing everything to get into this point. Now we're just figuring it out, and we've got a really good thing going. We can just buy multiple deals a month, manage them effectively, and standardize all across the country, and raise the capital very easily for these deals. So
When you're looking for property, so you guys are now vertically integrated, right? When you started out with the Airbnbs in markets that you were not in, what was your backup plan if your property management did not perform?
we were gonna have multiple.
Say, for example, you have an Airbnb in some market, you have the cooking oil issue, right? So you're local, you'll go and buy it, but if you're not local, then what were you doing there?
That's not my problem. I'm paying them money to go do that shit. I don't care how they do it. I don't care if they pay DoorDash to send them cooking oil now. At the beginning, I was so afraid of exchanging my cash flow. I was not going to give up my cash flow for anything. There was no way. And then I realized, holy crap, I can just DoorDash this, or I can pay the manager or the handyman and all this stuff. So pay all these people to do these things, and as long as I'm making my returns, and now I don't just look at my return on investment, I'm constantly looking at my return on time. Right? My return on time, especially with a brand new baby girl and my family, like that's way more important than maximizing cash flow. So I'm exchanging cash flow that's the same reason why I don't buy real estate anymore using my own money, because I have to generate the income, save it, and then buy that real estate. Or I can give up some of the ownership, raise the capital and give up the ownership, but allows me to have more of my time to do the things that I want to do, not try to drive income these other ways. So like that's a big thing, is evaluating. Return on time is hard to quantify, but when I'm doing things I don't like to do, or have no business doing, or it's not the highest and best use of my time, that's when I know this is not what I should be doing. Like, I mean, don't get me wrong, I still exchanged the door locks when I got here yesterday and all that kind of stuff. But like but I actually like that. That's the problem. I like maintenance stuff, but like, yeah, talking to guests and that kind of stuff. Bookkeeping, oh my god, I hate that with like a passion. Like, I hate that part of the business. I like the numbers and seeing the results and seeing how we can improve things, but the manual components or setting up QuickBooks, I hate all that.
So when you're going into a new market, are you always getting a backup property management in case one fails?
No, because we're only buying in markets typically that have populations of 30,000 or higher, typically like 200,000 or higher. So there's plenty of other options,
Okay, so you can just...
There's like nationwide property management companies, there's like local property management companies, there's people in Subto, I could give them 20% ownership, give them 20% of my ownership, and they'll be the boots on the ground to manage the property. Like, there's so many things we can do with like creative in mind. It's not just, you know what I mean? There's like so many ways, and I've realized a lot of my concerns, limiting beliefs, are not actually like real. They're like fabricated. I'm always like you tend to worry about things, and it's like, wait, there are all these other options.
Yeah, who take care of your rentals, like on a constant basis, like the flow of guests?
Our property management company.
Oh, okay.
Our own property management company does that. And like that's why I actually really love short-term rentals, because we have someone in there, or even our rent by the room or passives, we have people in there way more frequent than our long-term rental to make sure our properties are in like really solid condition overall. Because what we also don't do is we don't slumlord shit. That's why I don't want to buy an $80,000 house or whatever, because you kind of like